Hey, what is up everyone? It's David here. A while back, I was incredibly fortunate to speak to Rajeev Gupta from Alium Capital, who I deeply respect in the investment world. Before he started Alium, he started his illustrious career in Goldman Sachs, and he was actually part of the first team who invested in Alibaba before they were even public, and he met Jack Ma when he was still a teacher. I'll let Rajeev expand on that story later in the video. Then in 2011, he took the plunge to start his own technology company, and after 1,312 days, he sold that company, came back to Australia, and started Alium Capital. In our conversation, he broke it down for me in terms of what he looked for in a great company to back: the people, the product, and the price. And before we get into it, no, I'm not sponsored to make this video. It's purely part of my pursuit to become a better retail investor. On top of that, nothing in this video is financial advice or recommendation to do anything. It's just general information for entertainment purposes. Without further ado, let's go. Yeah. Correct. So you've seen a lot of things happen, like from the dot-com bust to the GFC. So let's start with what you did before Allium, and then help us understand what you're trying to do with Allium.
Okay. Firstly, David, thanks for doing this. I think it's a terrific idea. And I'm honored to be on this with you. I'll start at the beginning. I was born in the UK, raised in Wollongong, went to the university, and I struggled to get a job. Everyone in my cohort year ended up getting jobs by June, July, and I was about to enter final exams in September, October, and get a job. So I then coincidentally knew someone that introduced me to someone at Goldman Sachs, which was a firm that at that time in the mid-90s didn't exist in Australia. I ended up getting a job with them in Asia. So I started in Singapore, was with the firm for 10 years, worked in Singapore, worked in Hong Kong, worked in Silicon Valley, worked in New York, and had a terrific time being there, but also a wonderful time to learn and be part of, as you mentioned, the early days of the dot-com. So
we have to talk about your Alibaba, because it is to my impression that you did work on that deal.
Correct. Our firm was the first one to invest in Alibaba. Jack Ma, when he was still a teacher and thinking about the concept of building it. And, I met him on 68th floor in Chung Kong Center.
Oh my God.
In Central. It was an amazing experience back then. He had a spark, and I'm sure we'll talk about it later on today.
Yeah.
Some people just have a spark and they have a determination. He clearly, and size and stature has nothing to do with ambition, which is pretty clear. So I was firm for 10 years, went back to Asia, was part of the dot-com boom and bust, met a lot of companies. Whilst I'd been brought up with technology, I wasn't technologist per se, but, I got to meet data center companies, semiconductor companies, and then with regards to internet companies, marketplaces, content companies, ISPs, all types of different businesses. And it was an amazing experience. I then moved to a client of the firm and started investing in global technology companies, both public and private. Did that for many years. At one point got hired by a family office in Melbourne, moved back to Australia, did it for them. And then it was in about 2010, 2011, I got the itch and thought, if anyone's going to build a technology company and do an amazing job of it, it's got to be me. Started that, and it was hell every day. We made so many mistakes, but we learned a lot. And after 1,312 days of some pleasure but lots of pain, we ended up selling the business, which was a good outcome. And then that precipitated the move back to Australia. Wife, 4 kids. And so we arrived back in 2015. And then in 2016, we launched Alium Capital. And I wanted to, with the firm, bring to it some of the skills, some of the experiences that I'd learned in my prior career. And we meet today, I think about the pleasures that they go through, but I also think about the pain. And I think it's become a little bit easier for me to work out what works and what doesn't work. We still make mistakes. Right? It's inevitable. It's part of growing. But I find it easier to pick success.
And do you think that it's easier for you to identify and pick success because you being a founder yourself, so then you're empathetic to the struggles?
Partly. I think it's definitely that. It's never seamless process, nor does it ever go in a straight line. There are always different machinations around a different individual, their personality, their product, what they're trying to build. In many ways, I think investing the way that we do it is common sense. And common sense, it's about trying to find an individual who's cerebral, that understands, and to your point, is empathetic. So yes, we're empathetic, but we're also trying to invest in people that are empathetic, because at the end of the day, people want Jack Ma, as an example, is highly commercial. He's ruthless, but he's also empathetic, right? And I think you'll find that in most great leaders and businessmen globally, there is an element of being hard and tough, but
Yeah.
they're also understanding.
Let's talk about that a little bit more, because while we're on the topic, we might as well talk about it, because the first part of your investment process, to my understanding, is people, right? So then you've talked about the empathy side of founders. The first time that you meet a company, what is something that you look for within the founding team? And also, what are some of the alarm bells that you're like, oh, okay, that's not a good sign?
So any individual is also about the team. So you don't want it to be a business whereby you're only interacting with one person and they control, and they're involved in absolutely everything almost too much. You're investing in a team, not in a person, but you want to have a strong person at the front. So let me start with a strong person at the front. Strong person must have domain experience in terms of what they're building. Someone that's building a marketplace, you've got to understand the dynamics of a marketplace. Dynamics of marketplaces are about price and quantity. It's about being effectively pricing when there is either too much or not enough quantity. Simple economics, but it comes down to my original point. A lot of it's logic and common sense, right? So we're looking for the person to have deep domain experience. And so I'll take one of our companies like Koala. The two founders there, one is really strong in marketing, and that's his background. And the other comes from a family business that was involved in furniture, right? So you've got this of two founders that are strong in what Koala is and what it stands for. Right? Individually, we're looking for deep domain experience, but ultimately it's about a strong leadership team, right? So you must have people that are dexterous, so a technologist must be a strong technologist, not someone who just architects but then doesn't get on the tools. We see that's great, but it's not a kingdom, right? You've got to go to war. You've got to get your hands dirty.
So you want a general, like you want people who can like fight the fight and also like lead the team as well.
Right. They should be last man standing, right? So sword's going to go through. It's going to go through you at the very end. I think there's an element of the individual, as I said, and the team's just got really strong, really, really, really strong. The marketer's got to be a strong marketer. Business development has got to be done in a way whereby business development makes sense. I mean, there's protocols for how you do everything. It's getting the right person in the right slot. And then people often talk about culture. You test culture of an organization through the leader. So little things in meetings, right, David, as an example, if we've got three people in a meeting, the general and then the CFO and the CTO as an example, the general will back off at times and they'll read questions respectfully to their two other colleagues, right? Sometimes people come in, a team of three will come in and only one person talks. That's not really empowering. So if you're not empowering in a setting like that, you're probably not empowering when you're back in the office.
That's a great point.
So team is really important for us. So you said, pitfalls as well, or warning signs. In any meeting, it's okay to have a moment of silence. Sometimes in meetings, you have some people that just constantly talk. And then you realize at the end, oh my God, they're building a technology company, but their background is entirely marketing, right? So those ones are warning signs for us, right? And so company formation, as an example, globally is at an all-time peak because it's so easy to build, right? It's so easy. Agreed. There's grants and, there's people that can advise you. Everything's decentralized now. You don't need to go and get a job at, Procter & Gamble, Johnson & Johnson, as it used to be. So what we're finding is, for want of a better word, there are just so many spivs out there, right? So it's discovering, who is the spiv, right? Who is the guy or girl that just talks a lot? They make a sensational pitch, and then when you peel the banana back a little bit, there's not a lot there. So the pitfalls are fast talking, right? It's a big pitfall for me, and name dropping and blah, blah, blah. I don't like it.
Okay. So it's more about the substance and the product that they can deliver and their customers.
Yeah, just balance.
I know we talk about common sense a lot, but from time to time, common sense isn't exactly common. And it seems like our day-to-day world right now is very much growth, which is something that you talk a lot about. And before I talk about the new era of investing in companies that is not exactly profitable and no roadmap to profitability, I wanted to ask one more question on the founder's ability to attract talent, because it seems to me that, as companies grow, your ability to hire talent will ultimately determine where you're going to be.
Correct. That is correct. So I'll tell you what we observe, and the best ones. People that go to a headhunter job just is not great, right? So, I mean, if you think about it, they have a single role. They've got to find a person, and they care about the commission they'll generate. They will try and find the best person, but they won't also necessarily always find you the best person, if you know what I mean. It's a sample set that they get. Our best founders probably spend more time on LinkedIn than anyone else that I know. So we have one founder in particular. He's hired everyone, senior leadership team, through LinkedIn. So the individual reaching out himself. So he's just attracted a really good global CFO, and he reached out to her on LinkedIn, and she was working overseas and she's moved back to Australia. But it's that personal touch. Great founders or great CEOs, they do the hard work themselves. They obviously empower and decentralize as much as they once a person's in, but you've got to be involved in the process. So I remember Goldman, I remember back then when we were a private company before we listed, everyone that got hired, it doesn't matter what level you were at, 20 people had to meet you. And part of those 20 were people that you worked with. Some were people that in a different division, some people in a completely different geography. And what they were trying to build is connectivity. So they're building connectivity. And the best way of building culture is keeping you involved, right? So I was hired, and there was someone based in London who, I didn't even meet because it was a phone interview at that time. And, 5 years later, whilst I was at the firm, I needed something and I remembered XYZ, and I reached out to him, and, that connectivity was there because he goes, "Hey, Raj, yeah, knew you joined the firm." That kind of stuff's really important. So what I'm trying to say is, I think culture and leaders go hand in hand, and people have got to, I like how you're saying general, right? So the general has got to make sure that everyone that works in that group feels as though they're valued, and they're valued by them being hired at the very first instance by the general.
So let's build on that topic a little bit more and talk about product. Now that you have a great team, what is something that you look for in a great product in the very first time? Do you try it before you even go into the meeting, or do you?
We often do. Yeah. So I'll give you an example. We're investors in a business called Health Engine, which it's GP bookings, and they've moved
I use
into.
it.
Oh, you do? Okay, great. Dental, they've moved into allied health, physio, podiatrists, et cetera, et cetera. So we invested in them 3 years ago. Dr. Marcus Tan was the founder, CEO, and still is. As it turns out, my brother and my father are doctors, but I didn't tell him that. And then I assumed the identity of my brother and went through the whole process of using Health Engine in his practice, right? And they assumed Rajeev Gupta, it sounds Indian enough, it must be and went through that whole process, and it was really seamless, right? So then when we did a subsequent meeting with Marcus and the team, I told them that I'd used it, and these were the good things, and this is where there was a stumbling block. But you've got to test the product yourself. You've got to test it. And sometimes it's hard when it's not a consumer product. So enterprise-based product or specific to a certain industry that we're not involved in, you've just got to ask people. Right?
So you will call up customers?
Definitely, you must. You've got to find ways, right? And outside of our founders, I think the second largest user of LinkedIn is probably me. Just reach out to people and you ask them, right? Because you can always work out who's using what. And there's someone internally that will always give you a tidbit. Right. So there's few instances where some companies just don't say anything and we can't verify. We tend not to invest in those.
Oh, okay.
You need to get cross references, because at the end, if I want to tell you a great story, David, I can tell you a great story, right? But for you to understand me as a product, you got to speak to other people. So you should speak to our founders, right? Is Ryan, what's he good at? What's he bad at? There's no substitute for referencing. So we do that with pretty much all our products. We then, we sometimes we'll look at the data that's available publicly. We'll try and work out from a company, people that have left, if there was a developer that left, why they left. There's all kinds of, again, this is not groundbreaking in my mind. It's common sense.
Yeah.
Right. When people talk about what is your due diligence, we will tell them the due diligence stuff that they have access to, but there's stuff I never tell them, right? Because it's case by case, it's different for everyone, right?
Yeah, I find it really interesting because sometimes when I do due diligence on some of the companies I want to invest in, I tend to look at Glassdoors and see how long people stay at different companies and see what the churn rate is of their people.
Yeah.
If they churn a lot, then it kind of tells me that like, well, there's a reason why they're churning. Like, so that's really interesting. And yeah, sorry.
On LinkedIn, like if you pull up company ABC,
yeah,
and you can see all their employees, right? And you can also see employees. Just ping an ex-employee. Just say, hey, heard you were, how was it? They all respond.
Yeah.
All respond. Unless there's a gag order, right? But generally, we're not asking them to give away any details. We just say, hey, did you enjoy your time there? And they start engaging. Then you start delving deeper, right? CEO like, was there a stand-up every day? They talk about strong culture. Again, common sense.
I agree. The last piece of the puzzle that you talk often a lot about is the price. And I know that Alium has a specific focus on crossover investments. So you have investments in both public and private, and you're looking for companies who want to eventually go public. So I don't know how much you can share when it comes to how you would build your valuation on the company. And because nowadays it seems like software multiples are massive. Twilio trading at some exorbitant 3-digit number, and Tesla is, well, I don't need to talk too much about that. So can you share a little bit about how you think about valuation?
So we have, always believed in what Warren Buffett has said. He's always said, price is what you pay, value is what you get. We're very price sensitive, right? So every company that comes in will make, $1 million in revenue this year. Next year is going to 10. The following year is going to 50. Everyone's doing the, triple. Everyone's doing that. Triple, double, blah, blah, blah. We actually pay more for what's been achieved as what they will achieve. So there's a balance of if a company's made $1 million of revenue and they think it's going to go to 10, we'll almost weight it. Like, how much are we going to pay for that million? And how much are we going to pay for that incremental 9? Because that 9 incremental has a cost associated with it. And what is that cost? That's our money. How much of our money will go towards that 9? And if they're going to spend $15 million in cost to make that 9, it's a bad economic model, right? And most companies that go from 1 million to 10 million in their forecast end up going to 3. So there's always a miss, right? So we take companies' numbers and we scale and pare them back pretty significantly to more realistic levels. Then we ask, from a sustainability standpoint, not now, what type of margin will you generate, right? So, spivvy marketers will talk about gross margin, which is not relevant. It is the operating margin, like it's post-cost, right? So what margin will you generate? And 50% of founders have no idea, in which case there's more ability to negotiate. And the ones that do have an idea are the ones that have a really strong grip on building a sustainable economic business. We negotiate hard with those guys as well, and girls, but knowing how much money you're going to make it's all about profit, right? How many times profit? So we do discounted cash flow on a lot of companies, and we're pretty lenient with some of the metrics that we use, but the discounted cash flow goes out 7 to 10 years and it doesn't take the company's forecasts into account. It's what we think they'll achieve. And so let's say a business is doing 1 and they think it'll go to 10 and then it'll go whatever big number and they think the business is worth $30 million straight. If our discounted cash flow shows it's worth 12, we will bid and say, we think your company's worth 7.5. And in many ways, we're a take it or leave it deal. We don't negotiate to pay more. We're always negotiating to pay a little bit more than what we believe is fair value.
7 to 10 years in today's era seems a bit far.
Yep.
Especially, with what happened today, this year, and also how technology is changing different industries. How do you think about forecasting that far? Are you a little bit more conservative, or do you kind of give them, benefit of the doubt that, like, if they achieve these milestones, we'll give them a little bit more of a leniency on that, on the cash flow projections?
Yeah, so it's not complex. Right? DCF model is not 115,000 lines. It's pretty simple. Firstly, there's revenue. Revenue is a function of price and quantity. P times Q equals revenue. We try and work out what is the price going to be year 1, year 2, all the way out to year 7 or year 10. In terms of quantity, how much will they sell of it? Right. So we try and work out, is it single country? Is it multi-country? Is it single industry, multi-industry? So you build this matrix approach and you work out how big could it be and how much of that share will it get in the out year. They won't even achieve success in year 7 or 10, but at least you can build a narrative around it. So if a business company says, we're Australian, we're going to continue to remain in Australia, then you don't take global opportunity into account. So you can only limit quantity to effectively 17 million maximum if it gets to every adult, right?
Yeah.
And if their forecast is saying they're going to dominate and they'll have 3 million, but hang on, you're an Australian business, you can't ever have more than that, right? If you're focused just on this geography. So price times quantity is the first thing. Then everything's a function, often it's a function of people, right? So how big does your team need to be? In what areas? How big will your technology team be? How big will your marketing team be?
I see.
How much will your UX? All these, you try and work out what type of expense base the company will build.
Gotcha.
Right. So, here's an important measure we often look at. We look at revenue per employee, right? So, one of our companies based in the US, run by an individual who's originally from Adelaide called Jindal Lee, who's pretty well known. I don't know if you know him or not, Dave, but wonderful guy. Jindal's built he's built a software that caters to apartments, landlords, and property developers. And it's a really important measure for him. And the reason it's an important measure for him is once you know revenue per employee, you know how much you're paying your employees, right? So most people are generally paying between 75 and 150 grand on average. That's the average generally. You'll have some people that are a lot more and some that are a lot less. If your revenue per employee is above that, you're doing pretty well. Then you've got other costs, right? Of course you have other costs. But if you cover your staff cost, that's pretty goddamn good, right? So we have some businesses that have 70 people not businesses we've met. They have 70 people and revenue per employee is like $400. Like you got a lot to go and your valuation's wrong.
Okay, I gotcha. I know we don't have that much time left, so I'm gonna cherry pick a few questions and then we'll jump into a lightning round and then we'll wrap this up. I'm going to quickly jump in here. I asked Raj to share a success story with me, and it turns out that the company is Cashrewards. Now, I want to remind you that this video is not financial advice or recommendation to do anything, but nevertheless, he shared a great story. So here's what he said.
Sure, let me talk about Cashrewards because it's fresh.
Coming up? Okay.
Yeah, okay. So Cashrewards we invested in a couple of years ago. It was run by a single founder, 61 years old, Andrew Clark. Came in and he said, I've got 500,000 members. I've got, 1,000 merchants. And I'm like, God, that's pretty good. And I've never heard of you. We did a lot of work, went to their offices in Chatswood, which I also liked. So they don't have Surrey Hills or CBD offices, basically on the Pacific Highway. So there was something authentic and real about it. And he had 40 staff at the time. We invested, we were the first institutional shareholder. And as it stands, there's a new CEO that's come in who's been brilliant, Bernard Wilson. And the company's doing a public offering in about a month. And in the press today, ANZ made a strategic investment, which is amazing, right?
Yeah.
And a lot of work that went into that. What I've learned with that business is simple stuff just works. So you go to Cashrewards and you click Apple and buy any Apple device and you will get cash back, right? So there's no, I mean, if you go into Apple Store, they don't have a discount, right? They never discount. Cashrewards allows me to upgrade my home Mac, my kids' iPads, my phone, and I buy $1,000 device, and then in my bank account, I've got $15, right? So that's on one single device. So I'm getting a discount where I wouldn't have got one and don't get one typically. And it's just, you can buy alcohol through Dan Murphy's, groceries through Coles. You can buy a pair of ASICs. It's got everything. It's just really simple. And it's a case of why wouldn't you? And there's part of that when we first invested, it was like, it's almost too good to be true. So we were first investor. We had some negotiation power. We helped Andrew get the business to where it is today, and he'll be, a couple of $100 million when he lists.
So I did some digging for Cashrewards, and I have a question for you. It seems like the buy now pay later have taken a good chunk of the consumer spending. Is Cashrewards going to sit on top of that ecosystem, or are they going to be? It's either going to be buy now pay later versus Cashrewards.
Yeah, there will be a nexus. There'll be an overlap, but I think what's important is the budget that pays Cashrewards is different to the budget that the BNPLs get. So BNPL is at the very bottom, transaction completed, then you choose. So it's a cost item, whereas Cashrewards is reimbursed, and then you as a consumer get that through the advertising and marketing budget, which sits higher, right? So
I see.
OpEx, right? It's part of operating expenditure. It's not out of transaction cost.
Okay, I get that from the business perspective. From the consumer perspective, we have jobs to be done, right? We either choose to use a certain payment system and go with buy now pay later, or we will go with Cashrewards.
So we're not a payment system. We're just giving you a discount. We're giving you cash, right? Whereas those guys are splitting, right? So they'll split into 4 or whatever it may be, right? So we in fact work with some BNPLs, and we're working with a few more that'll be announced in the next couple of months.
Okay.
So they work together, but they're not
competing. Okay, understood. I'm definitely watching that one because the amount of traction that they got and the sessions that they get, they're really nailing a lot of different things that some companies just cannot. Even with some of the more techie IPOs nowadays, it just seems too good to be true. It's like the story is really good, but like you haven't shown anything.
I agree. This business does $1 billion, almost $1 billion of transaction value, right? And not many people have heard of it.
Yeah.
Right? So this ASX IPO will hopefully be very good for them from an awareness standpoint.
Yeah. We only have a couple more minutes left, and there is a couple lightning questions I want to ask you. What is the one piece of advice that you've given your children recently?
I did say something to them during COVID. It's nice to be important, but it's more important to be nice.
Very nice. A public company that you're rooting that will change the world?
Tesla, still.
Fair enough. It's such an honor for me to talk to you. I am very, very thankful for the opportunity. And thank you so much for being here. Well, thank you so much for watching this video all the way to the end. If you have learned something new, consider gently smashing that like button right there. And let me know in the comment section below whether you enjoy videos like these. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.